Hello, welcome back. Hope you're doing well. I think myself, I may have actually contracted COVID. I actually was with some people that were tested positive, and the next day I started getting a little bit of a flu like case here. Thankfully, so far it has almost been treating me like an allergy, like 5 days in. Hopefully, it's going to continue like this, but the stock market cannot wait. And so I will be tackling some of the suggestions that you had and some of the stocks that you wanted me to examine. And so we're going to be starting with Twilio. It's one of the stocks that I have on my backlog. And over the weekend, I will try to do as many as possible. Hopefully, I will continue being as I am today, which I have like a less slight like feeling in my throat. But other than that, everything is okay so far. We'll see. But let's examine Twilio here. It's down 73% from its 1 year high. And you notice that it was $400. Right now it's sitting at 100. So this is potentially an interesting buy right here. But we do want to see what the company is doing financially, of course, before we decide to do so. It has been an overhyped company, of course, for a long time now. But if you take a look at the price to earnings ratio, you will see that it's been negative all over the place. And so we are actually handling a negative earnings company here. And the question is always, how do you value these companies? Now, I have made a video about it, but there's always extra risk on doing so. So you have to be super careful. One of the ways is by looking at the price to sales ratio, because revenue is interesting here. You can kind of use it to deduct whether this is a buy, because your earnings are going to be negative, and so you can potentially even use EBITDA to define that. But the price to sales kind of tells you how expensive the price of the stock is compared to the sales, which is the revenue that the company is doing. So if you have a very low number, it may actually deserve a little bit of a buying action here, maybe. But you will notice that the margins are negative, return on equity and assets is negative, something that I don't like to see, of course. I am very sensitive in terms of margins and the amount of money and cash flow that the company generates. Because if a company is not generating money, what's its worth? It's tough to say, and you can actually potentially buy a company that's not making money. But again, you're gonna be having a lot of extra risk. And one of the nice ways to deduce whether it's worthwhile is actually using a discounted cash flow model. It's probably the best way. So let's examine what's going on in terms of their financial statements here and examine the details of the company and how they are doing. From 300 and almost 400 million here to 2.8 billion. So we're looking at explosive growth. This is a nice thing to see. But growth has a price, and this is what we need to determine. Because if a company is growing, they can be growing forever, and if they are not making money, it doesn't make any difference. We need to be having a company that is generating profit, otherwise it doesn't matter. Like imagine you had a business yourself and you were able to sell $1 million, and out of this $1 million you made minus 10,000. So you actually lost $10,000. What's the point of this one? Unless you can prove that you can scale this quickly and become positive in terms of net income very soon, then you're basically losing money every year. And don't think that because a company is making a lot of revenue, will automatically in the future be making tons of money. This is a completely different ballpark, and they definitely have to prove that. So don't just take that leap of faith automatically just because they are selling a lot. It's important that the revenue is increasing, but they need to be making something with it. Now, the net income is, as you see, negative and negative and negative, and this is a very negative sign. I want the company to at least decrease its losses. Okay, this should be the opposite way. Like 900 million should be here and 63 should be here. That would make some sense. But now the company is becoming more and more negative. So where do you buy it? Now let's take a look at the balance sheet. I forgot to mention, by the way, this is a very important point, which somehow I forgot, probably COVID. Outstanding shares here, look at this one. The company is basically financing themselves with outstanding shares. 100% increase from its last 5 years. This is an insane increase. 181 million right now is the stock, the outstanding shares, which is 100% more than what it used to be 5 years ago, which was about 90 million. So this you have to factor in your calculations as well. The company is massively diluting investors. A very bad thing to see. Now let's go back and take a look at the balance sheet. Now you will see here that the total equity of the company keeps increasing from 300 million to 11 billion. An insane increase in total equity, but you will see that the additional paid-in capital has been tremendous because investors were kept on buying stock. that the company was offering to them. And you will see here that the company is basically financing themselves through additional paid-in capital is how they're making their money here. And they do have a little bit of debt here as well, to be expected. But the total liabilities are only 2 billion here, which compared to total assets, it's much less. Again, assets coming from investors. And I want my companies to generate their assets from operations, not investors. At least at some point soon. It can happen in the first few years, but you have to show me that you can actually reverse the situation. Otherwise, what's the point? And you'll see that the net cash provided by operating activities is negative here. And again, we are starting with negative net income, so we're very close to negative free cash flow, of course. And if you also include the capital expenditures here, you are getting to negative free cash flow every year. Now, you will see here that the cash from investing activities for the company has been negative because they are purchasing investments. And how are they purchasing investments? It's stockholders' money. And so this is a point where you are looking at a company that is almost acting as a hedge fund. They are basically issuing shares of their company and buying shares of other companies. So what's the point of doing that? You can do that on your own. Like, do you need a financial advisor in Twilio? That's a good question, I think. So, cash from financing activities here, 3 billion is their current value, which means that they are actually getting more, issuing shares or getting debt. And as you'll see here, it's a lot of common stock issued over here in the previous year and some extra financing as well, 1.3 billion too. So getting a little bit of everything over here. And the cash that they have on hand is about 1.5 billion over here. Now, if we examined the stock analysis chart earlier, we saw that the company doesn't have too much debt when you compare it to equity, because again, equity has been offered by stockholders. And so this means that basically it's a low number because they have been issuing shares like crazy. And this is a solvent company probably, but it's not to be trusted. Again, it's solvent based on the equity, not really on the money that they are making, because look at this one, the free cash flow to total liabilities ratio is a negative. Of course, they're not making any free cash flow. So practically speaking, it's not a nice thing to see here. And we're looking at a company that has substantial debt compared to what they're generating is the thing. Not to their equity, but what they are generating, they basically are not making money. Okay. So, can we do anything with our stock evaluation tool? This is probably a company that I wouldn't look further into, to tell you the truth, because I don't like the picture in terms of the net income here. I really don't like that. This is getting more and more negative. Again, if it was the opposite way, then it would make some sense. But we're starting with $1 billion loss here. And the previous year it was 500 million, then 300 million. Like, it's getting increasingly worse. So where will it stop the bleeding? It seems to be worse and worse. And so let's just say that we're using a revenue growth of 30, 40, and 50, which is absolutely outlandish. It's almost impossible to achieve something of that sort. What do you use for the net income margin? There is no net income margin. All of these are negative. So what do you use here? Can you use maybe marginal profitability? Let's just say 1%, 1%, 2, and 3 here, maybe. If at some point becomes positive, this is a stretch, of course. What about the free cash flow margin? This looks positive, and it is, but the thing is, there has been a division between the free cash flow and the net income, and that makes it a positive value. Practically speaking, it's negative out of a negative, and so this is practically speaking a value that you cannot really use, and it actually ties free cash flow to profitability. And when we have no profitability, what are you going to do? We can't really know what the company will achieve. We can assume that they may achieve something like 60, 70, and 80% of their net income, convert this to free cash flow. Let's just say, again, these are assumptions. 13% is what I typically want to make. And if we have these projections here, we are looking at a company that is, as you see here, extremely expensive for what it's currently doing. And I just can't see myself getting my hands on this one. Very, very speculative, and I would be very, very scared of losing a lot of money in this one, as has happened. I mean, you will see this kind of extremely overbloated investments here. They lose 70%, 80%, and the problem is, it's a different thing to lose like 60, 70% on a company like Facebook, because it's making tons of free cash flow, and its valuation goes lower and lower, and then it costs like 2 packs of cigarettes to purchase stock. But this one is actually negative all over the place. So when will it stop is the question. And if it reverses, what's the reason for the reversal? It's going to be hype and not the financials, at least at the current time, at the moment. it's not looking good for the company so far. Now, what will happen in 10 years, we don't know, but we don't know anything about other companies as well. So Twilio may be a fantastic opportunity come 10 years later and it's like 2020 hindsight, or it may fail. I mean, you cannot know for sure. There are millions of companies and some will fail, some will succeed. The thing is, where do you draw the line in your investments? Where do you actually buy and where do you actually wait for a drop or just avoid completely? And for this one, I will probably avoid myself. Thank you for watching the video. Tell me what you think about Twilio. It's good that my voice is still okay. Good to see. And I'll try to make some more videos coming up shortly. Thanks for watching this one. And remember to like and subscribe. And I'll see you in the next one. Bye-bye.